Good morning, everyone. Most people think the stock market is about picking the right stocks. It's not. Because if that were true, the majority of investors wouldn't consistently underperform the market. So here's the uncomfortable truth. The top 1% are not winning because they are smarter. They are winning because they are playing a completely different game. And in 2026, that gap is widening faster than ever. Today, I'm going to show you exactly how they think, how they position, and why most strategies you see online are structurally designed to fail. Let's reflect your thinking first. The stock market is not a place where money is made. It's a system where money is transferred. From impatient to patient, from emotional to disciplined, and from reactive to structured. And here's the key insight. The market does not reward efforts. It rewards behavior and positioning over time. So instead of asking, what stock should I buy? The real question is, how do I build a system that wins regardless of noise? So what is that something that the top 1% actually do? Here is the answer. The top 1% follow three principles. Not trends, not hype, but principles. Remember that. Number one, they prioritize allocation over prediction. Retail investors try to predict the market. Smart investors allocate across outcomes. They don't ask, will this stock go up? Instead, they ask, what happens to my portfolio if I am wrong? Because survival is more important than returns. Number two, they build around asymmetry. This is where the most people fail. Top investors look for situations where upside is large and downside is controlled. That's called asymmetry. But retail does the opposite. They chase a small upside with massive risk. And number three, they optimize for time, not timing. You need to understand that. Timing the market sounds intelligent, but in reality, it's one of the fastest ways to destroy consistency. Top investors focus on time in the market because compounding needs duration, not perfection. The world is evolving faster than an ordinary human can adapt the change. Because this fast technological advancements like AI, machine learning, robotics is used by millions across different continents, and cumulative mushroom of advancements has multiplied multifolds. And thus, after 2025, things have changed drastically. We have covered 2026 by one quarter, and here's where things get serious. The market in 2026 is not the same as it was back 10 years ago. The market has made three structural shifts. Number one, institutional dominance. Large funds, algorithms, and capital pools control the majority of value. This means retail investors are reacting and institutions are positioning. Number two, information is no longer an edge. Everyone has access to data. Everyone has access to news. So information is now priced in instantly. Your edge is not information anymore. It's interpretation and discipline. Number three, volatility is engineered opportunity. What looks like chaos is often a structured movement. Volatility is not risk for professionals, it's liquidity. Here's a simplified version of how serious investors structure their portfolio. The way serious investors structure their portfolio is very different from what most people are doing, because they do not treat all their money the same and instead divide it into clear layers and specific purposes. The first and largest portfolio, usually around 60 to 70%, forms the core foundation, where money is placed into broad market exposure, such as index funds and diversified assets that are designed for long-term compounding. This part is not meant to be exciting. It is meant to be stable, consistent, and quietly powerful over time. The second layer is typically 20 to 30% and is focused on growth, where investors take calculated risk through sector bets, innovation-driven companies, and high potential opportunities that can accelerate wealth but still remain within a controlled structure. The final layer, which is only about 5 to 10%, is reserved for tactical plays, where short-term opportunities like market inefficiencies and high-conviction ideas are explored, but with strict limits so that mistakes do not damage the overall portfolio. The critical mistake most people make is that they reverse this entire structure, putting most of their money into risky decisions while trying to be safe with what remains. Whereas serious investors protect the majority, grow a portion strategically, and only risk a small part where it truly makes sense. The biggest advantage of the top 1% is not capital. It's emotional control. They don't panic in crashes. They don't chase in rallies because they already decided their strategy before the market moved. So if you can remember one thing, then remember this. The stock market is not being right. It's about being structured enough to survive being wrong. Because over time, its structure beats intelligence, discipline beats prediction, and system beat emotions. In the next video, I will break down something even more important, where smart money is parking cash right now, in high-yield systems that most people completely ignore. Take care of yourself. Do not stress. Stay connected to your family. That is the best and the only wealth, the generational wealth that is never lost and only multiplies multifold. And if you have your parents alive, or even if one of your parents alive, then they are the mountains of real pure gold. Value them. Spend time with them. Love them, respect them. Take care of them as they took care of you when you were young. And even if they failed according to you, then it does not mean they have no value. They were just like us when you were born, with struggles, fears, inexperienced. They tried as you are trying right now, or will try in the future when you will become father or parents. Remember, businesses fail, money gets spent, but you don't lose hope in them. So why lose hope in parents? Always remember, every single person is important, while the most important is your family. So no exceptions. Take care of yourself.